Welcome in. Today, we're tackling one of the first and most important choices every new investor has to make: ETFs or mutual funds. We're going to break this down from an economist's point of view, focusing on what really matters for long-term success. So, you've decided to put your money to work. That's an excellent first step. But right away, you hit a big question. What's the right way to even begin? The options can feel overwhelming, but it often boils down to one key decision. And that decision is between these two heavyweights: exchange-traded funds, or ETFs, and mutual funds. Now, both are designed to give you broad access to the markets, but they're built on fundamentally different philosophies about how markets actually work. Okay, let's start with the first contender, the classic mutual fund, which is all about something called active management. Basically, a mutual fund pools money from lots of investors like you into one big pot. That capital is then handed over to a professional manager whose entire job is to buy and sell assets, trying to grow your investment. Think of it like hiring a star chef. With a mutual fund, you're not just buying ingredients at the store, you're trusting a professional who promises to find a unique recipe, a special combination of stocks, hoping to create a dish that's way better than average. And the appeal seems obvious, right? You get professional oversight. While you're at work or enjoying your life, a team of experts is supposed to be making all the right moves for you. It's a very hands-off approach, which is tempting if you don't have the time or the expertise to manage it all yourself. But that star chef comes at a cost, and it's a steep one. From an economist's perspective, this is the crucial point: the fees. You pay high management fees, and over decades, the compounding effect of these costs can devour a huge slice of your potential returns. Plus, there's absolutely no guarantee that their special recipe will actually beat the market. All right, now let's shift gears to the second option, the ETF, and see how it's based on a completely different philosophy. An ETF has a much simpler, and you could say more humble, mission. It doesn't try to beat the market. Its goal is to be the market. Its sole purpose is to mirror the performance of a specific index, like the S&P 500, by holding the exact same stocks in the exact same proportions. This is called passive management. So instead of hiring a chef, with an ETF, it's like you're buying a slice of the entire market's cake. In that one slice, you get a little taste of everything: a piece of Apple, a crumb of Microsoft, a bit of Amazon. You get instant, massive diversification with one simple purchase. The strength of this approach lies in its efficiency. Since you're not paying a team of chefs, the costs are incredibly low. You have total transparency. You can see exactly what you own at any time. And because they trade just like stocks, you have the flexibility to buy or sell instantly during market hours. The flip side, of course, is that you're on your own. There's no manager stepping in to sell if the market crashes. You're riding the market's roller coaster, both on the way up and on the way down. And the initial decision of which cake, that is, which index you want a slice of, well, that's up to you. Okay, let's put them head to head and see how these stack up on the factors that really matter for an investor. Laying it all out like this, you really see two opposing philosophies. With ETFs, you get a low-cost, transparent, and flexible vehicle. With mutual funds, you're trading that flexibility and transparency and paying higher fees for the promise of expert management. And that brings us to the million-dollar question: is paying for that expert chef actually worth it in the end? Here, the economic evidence is just overwhelming. Study after study shows that, over the long term, the vast majority of active managers, despite their expertise and their high fees, fail to beat their own benchmark index. So, what does all this mean for you, the smart investor who's looking for the most logical and efficient path forward? Based on the evidence, for most people starting out, the answer points very strongly toward ETFs. Their combination of low costs, simplicity, and solid market-matching performance makes them an incredibly efficient tool for building wealth over the long haul. So the choice really boils down to this. With mutual funds, you're paying a premium for professional support and total delegation. With ETFs, you're choosing maximum efficiency, simplicity, and the powerful advantage of low costs, which lets you keep more of your hard-earned returns for yourself. Ultimately, while understanding this choice is fundamental, the real key is just to get started. The power of compound interest waits for no one. So the most important question isn't which tool is perfect, but when are you going to take that first crucial step?